Hello, everybody. How's it going? I keep alternating between using the built-in microphone and then using the Logitech webcam microphone. I have no idea which one's better. I really have not tried to improve this experience at all in the last year, except for buying the Logitech webcam. So you're just gonna have to deal with a C- user experience because you get what you pay for. I have not done one of these since early August, and I've mostly been completely off of Twitter too. I'm still engaged in the markets, but just trying to be a little bit more isolated from being around other people while I lose money on a near daily basis. But I'm feeling pretty good about the portfolio, and I feel good about my core positions. And I thought I would just catch up with you guys and tell you what I think about the individual names and what's happened in the last 6 weeks. And then also take any questions you have about any other stocks. Though it looks like there's only 4 of you on here. So I'm not exactly sure we're going to get a lot of feedback. I only announced this 30 minutes ago. Anyway, let's get started. So let's start off with obviously the 2 biggest positions I have are MagnaChip and Groupon. I guess we'll do MagnaChip first since that one's the easiest one of the 2. So MagnaChip announced this week that they were pulling and refiling with CFI US, CFIUS, and that surprised me only because I assumed that we would kind of have this come to an end this week, that CFIUS would block and we'd get our breakup fee, and that would be the end of it. So it definitely was a little surprising to me that they pulled and refiled. It's unknown why that happened. So the first break date is September 25th, and either the buyer or the seller can extend 2 more times through March if there's certain issues outstanding. So it doesn't have to be agreed upon. That said, if either party or both parties, I should say, knew that there was a 0% chance at getting this deal done, I don't know what exactly the point is of paying lawyers and twiddling your thumbs for months ahead of it dying. So it's obviously not a negative that the application was pulled and refiled. I still believe strongly that MagnaChip is extremely oversold, and absent a few very large black swan events happening, it'll go up from here. We'll make money from here. I mean, the biggest black swan event would be that Samsung pulled some or all of the business. Obviously, if that happened, that would be a disaster. But absent that, it's hard for me not to see this stock much higher in 6 to 12 months. I've talked about this ad nauseum already, so there's really no reason for me to get into details, any more detailed than that. Happy to take any questions, but it remains tied with my biggest position, and I like MagnaChip. Groupon is definitely more interesting of the 2 to discuss, since Groupon pretty much only goes down every day, though MagnaChip also pretty much only goes down every day, but that at least I think has found a floor. With Groupon, the last time we spoke was right after earnings, and it was trading at, I think, 32, 33 in after hours. Or I'm sorry, not after hours, during the market hours on that Friday. And I said I sold all my common the night before, but I still had a pretty big or very big options position in it. And I'd be interested in buying more or buying back my common or doing whatever if it got into the mid-20s. Well, here we are at 21.16. And like I said, it pretty much goes down every day. I have bought a lot of my stock back, and I've bought a lot of call spreads in it. And I think my favorite trade is January 23 calls and January 23 call spreads. So the idea behind this is that Groupon is basically being priced for either being a 0 or having a viable business going forward. There really is no middle ground. If you go back to 2017, 2018, 2019, Groupon kind of just middled along. The EBITDA was basically flat. They were bleeding users, they were bleeding billings, and they would offset that by cost cuts. So it wasn't a growing business. It wasn't even a stable business. It was a bleeding business, but just slowly bleeding. Fast forward, of course, the last 2 years, and you've had massive volatility, well, all down volatility. And it started with, of course, them announcing that they missed Q4 2019 in February of 2020, right before COVID, and that they were going to exit goods, and that it was going to be a multi-year restructuring, yada, yada, yada. COVID happens. Now you have both of these things happening at the same time. A company that was already having problems, and then you also have to deal with COVID. I think that we will know by Jan 23 whether or not this business has a core base that can grow, or if it's a terminally declining zero. And if there is a core base that can grow, which I do strongly believe there is, and I'll get into why. I've talked about it before in the past, but I'll get into why in a second. Then you're not looking at a $30 or $40 stock price. You're more likely looking at a $80, $90, $100 stock price, because the math is just is simply that the market won't put 4, 5, 6 times EBITDA multiple on something that is showing stability, and to the extent that there's no longer a question of the company's business model viability, because that's what people have thought for years, that there's real questions behind the business model, and they're rightfully, rightfully so that they're questioning it, right? All it's done is fail for basically, a decade. So the way I look at it is those Jan 23 calls and call spreads. I'm mostly just long the calls, but it's confusing because I used to have call spreads on and I rolled down the call spreads. But the 35 and 40 strike of the Jan 23 calls are trading at, I'll pull them up here. Again, I think the best way to put it on is via call spreads. But if you don't do it via call spreads, I'll just give you an example of the kind of risk return you get here. The 35s are, call it 360, okay? And I believe that, like I said, if Groupon does show stability and growth, you look out next year in 2022, and you should get to a 175 to 200 million EBITDA number versus 115 today. Let's say it's only 150 versus 115 today. If they're showing traction by the end of the year, and you look out to 2023, that number should be well north of 200. Again, I think I'm being pretty conservative with these numbers, but whatever. The idea is that it's going in the right direction. If you get to a 200 number in 2023, just to be simple, I think the market will put a 12 to 14 times multiple on that. And that gets you to a 2.4 billion market cap EV on the low end, on the 12 times. And you're at a 650 million market cap right now. So the stock would be north of $90 a share, basically $80 to $90 a share. And those calls, will be worth 60 versus the 360 you're paying for them. So you'll make 15x. Generally speaking, the call spreads all pay off the same kind of thing. So if you put on a 35-65 call spread or a 35-60 call spread, you're going to get 10 to 1, 12 to 1 kind of odds. And the way I look at it is, I think it's probably a coin flip, whether or not what they're saying is true regarding the inventory issues that they're having. And for a 1 in 2 chance that it is true, then you make 10 to 15 times your capital. And also those calls, the Jan 23 calls are long-term capital gains, whether it's a call spread or it's with the call spread, you have to take it off before it expires. But with the call, the same thing. You have to sell the call in the open market after 365 days, and it's a long-term capital gain. I did I was part of a CEO call with Groupon a couple weeks ago, and I didn't learn a great deal beyond the confidence that they have that the inventory is going to come back. And if you look at, if you listen to the fireside chat that the CEO did a couple weeks ago, which is a day before our call, he says the same thing. All I can say is, like I said, I think on my last YouTube, it intuitively makes sense to me. I mean, in San Diego, there wasn't a single concert in the month of July. If you talk to people that have been on vacation, I know someone that went to Hawaii, and all the things to do, bucket items were booked out for 6 months, 3 months. So I don't think that will be the thesis breaker, that the old inventory doesn't come back ever. I think that you have a very interesting setup right now, both in the intermediate term and the long term. Like I said, going into the last quarter, the numbers were good. We knew that April was 71% of 2019. And now the market expects the worst. July was like 61 or 62%. And obviously August is probably going to be worse than July. But as you get to October, which will be published when they do earnings in November, if that October number shows anything in the mid to high 60s, it'll almost refute the bear case that this is a terminally declining business, because you can see that bump from the July number. And it would speak that the things to do vertical was the reason why they had a problem this summer. And then you have the whole Delta variant and where that's going over the next few weeks. I think that by October 1st should be well behind us. And I really like the setup. I like the setup. I own a lot of November, January, and April calls and call spreads, 25 and 30 strike. I own common. I just have a lot of everything, and today it's a 650 million market cap. One thing that was brought to my attention that I think is really interesting is that I've said before that you shouldn't look at the goods business at all. The goods business is completely irrelevant, and I'm trying to hammer that down to management. But I didn't understand the idea that the concept that international in Q1 and Q2 has actually been international local has been a drag on the overall business, which makes sense, of course. In the first quarter, international only did, I think it was 30% of 2019. And in the second quarter, I think it was at 50% of 2019. So a better way to look at the core profitability of this business it's not even in a non-COVID world, because the United States had COVID in Q3, Q4, Q1, and Q2. But if you strip out international in Q3, Q4, Q1, and Q2, the trailing 4 quarters, my guess is that international was at least a 50 million drag on EBITDA over those 4 quarters, which means that those trailing 4 quarters, which I think put up something like 140 or 130 million of EBITDA, really did like 170 or 180 million of EBITDA. And it's totally intellectually honest way to look at it, because international was completely shut down. And you wouldn't want them to divest international, because in the past, in 2019, international was actually much more stable than the US. There's a core business there that was not declining. If you pull up the unit numbers and you pull up the quarterly customer numbers. I like Groupon for a lot of reasons, okay? It's very hard for people to get behind this name from an institutional basis. Every single sell-side firm has a seller hold on it now. The one buy guy left his firm a few months ago. The messaging behind the company could not be more confusing. Everything about it needs fixing. So they publish revenue numbers when revenue doesn't matter because of the goods transition from third party to first party. Okay, they lump trailing customer numbers with goods and with local, when goods is completely irrelevant. I'll remind everybody, they were exiting goods completely, divesting the entire division in February of 2020, and reversed when COVID happened because they saw an opportunity to get cash flow out of it. Today, they're only running at 30% of 2019 goods. It's obviously extremely competitive, but they've virtually transitioned the whole business to a third-party platform. And I confirmed with management in my call a few weeks ago that they do not have, dozens or hundreds of employees managing goods. It's a sliver of a staff that is basically there to support the third-party warehousing and distribution, listing, or whatever. I didn't get a good handle on what goods could fall to where goods would not be profitable. 30% in 2019 is pretty low. Putting that all aside, the money and the value is in local. That's the only edge they have. They have no edge in goods, just selling random shit, on the internet. Their edge is that they have relationships on a local level and on brand-wise on a national level to sell local experiences to people at a discount usually. Whether they do that going forward as a discount or not, who knows? So that's the first problem, the messaging when it comes to goods versus local and revenue versus gross profit. You look out to 2022, the problem you're going to have is that the revenue numbers are going to all look like they're declining from 2019. 2022 is all going to look like they're declining from 2021 because you had this third party to first party problem. That next year everything's going to be third party, but a lot of 2021 was first party, and that inflates the goods and that screws up the revenue numbers. The short interest is through the roof. It's above 4 million shares now, the most it's ever been in the history of Groupon, well, at least going back many years. And people are hyper-focused on the consolidated business. And like I said, the goods business is declining. The goods has been decimated this year. And they're hyper-focused on the credit card data, which shows that July and August are worse than April and May. There is no institutional ownership of this stock. There are two large fundamental shareholders that I'm hopeful are engaged. One used to be an active shareholder, MIG Capital, and they did not sell any stock last quarter. So they're still involved as of June 30th. And then the other shareholder is Par Capital, which has a great reputation, and they've been buyers every quarter. And the CEO, of course, remains interim. And that was hammered to them on the phone call a few weeks ago, and I got nothing out of them about when or how that's going to be resolved. To me, I know this sounds crazy. To me, the biggest risk on owning those Jan 23 calls and call spreads is it gets acquired at 35 or 40, and then you don't make any money on these calls or call spreads. I don't think that's a huge risk. I don't think this company's going to acquire it anytime soon. I think that in order for Groupon to be a viable M&A target, either from a private equity standpoint or from a public market standpoint, they have to show that the base business is growing, that there is a core business there that can be valued, and then you could go from there. And as of now, nobody has any idea what that base business looks like. But if you look at if international just goes to break even, which it should do much more than that now that COVID in UK and Germany, they're completely opened up there. And I don't think they're ever going back. So they also have Australia, and Australia is a little more difficult. But UK is like where most of their business is. If it just gets to a $5 million a quarter, contributor in EBITDA versus a burn, you basically are looking at over the last 4 quarters, and some of this was goods profitability, but not a lot of it. So it's a little bit confusing. But you're looking at something like you're probably looking at a $200 million EBITDA based business over the last 4 quarters. Over the last 4 quarters, given the cost cuts, and none of this is showing up in the numbers. And the sell side is not talking about any of this. None of the notes could talk about any of this, about what's going on under the hood and about what the core profitable base business is doing. So the setup, I think, is just very different than the way it was in the past. Like I said, before we were going into this, where the market expected, mid 70s, high 70s, low 80s, 2019 in August, July. Instead, we got low 60s. And the other thing that someone brought to my attention, I think is really smart, is that in October, November, and December, and of course, January, February, March, the things to do category is less important. And you're going to go back to the categories that Groupon's doing really well at. So spa and beauty, people are inside, it's cold, whatever. And you should see really good numbers in those categories come those months. So I think there are a lot of ways to win here. I think people forget how volatile the stock is. It could very easily go up 100% on any sign of a quarter that shows acceleration. It went up 100% on the in Feb of 2021 when they put up a meh quarter and guided to what I thought was meh, and the stock went from 35 to 63. So it's easy to get frustrated by it. I am surely frustrated by it, but I really do buy the calls and the call spreads every day, or mostly every day. And I kind of get faked out a little bit when it goes up and thinking that it's finally bottomed, and it doesn't bottom. So from the margin of safety perspective, you don't have one as much anymore. It's a 650 million market cap. Throw out your number of your EBITDA. It's obviously trading at extremely distressed levels. The reason why the safety is hard to say is because if it is declining and they have no base business, then that EBITDA is going to go to zero over the coming years. And there's no business model. And it's hard to know how they salvage that. I don't think that's the case. I strongly don't believe that's the case. And I can see why no one on Wall Street wants to stick their neck out and buy this company after all it's done is disappoint. And to me, that's just a tremendous opportunity. So, I said it on my last YouTube about this, but when there's fear, I get greedy. And I thought that at 32, 33 during the day, but I said, I was going to wait till the mid 20s. And for the most part, I did. I started putting out some call spreads that day, unfortunately, but I did wait to buy the majority of my position back until, 25, whatever it was. And I've been buying since. So I don't think there's any rush. I also don't really think it's going to go down a lot more, though I've said that before in the past. I have no crystal ball. I think that you could always wake up to news here, whether it's M&A or a permanent CEO, or, we're due for some good news here. I don't know what shape that's going to come in or what form, but it's a very frustrated shareholder base. And, anything could happen. You could have a new activist that can come in. So that's Groupon. I think I've covered everything I wanted to cover there. Yeah, let me see if I have any questions before I go on to other things. No questions. Good. Talked about MX. Talk a little bit about Dell and VMware. I still have a position in that, though I said I basically sold it all out. It's pretty big, actually, the Dell position. VMware has gotten destroyed the last few weeks since earnings. People are worried about their hot division decelerating. I don't have a lot to say about that, but adjusted for the dividend that they're going to pay, VMware is really cheap, and Dell is under 10 times free cash flow, or about 10 times free cash flow now, maybe, adjusted for the VMware dividend. So there's nothing sexy about Dell and VMware, but I still think that you have lots of events over the next 12 to 18 months there that the market's missing. With VMware, it's not just the S&P 500 inclusion, but it'll be the first time in its corporate history it could either be acquired or it can acquire somebody. And that's never happened before. They've never been able to do that based on the 81% ownership of the parent. With Dell, they're going to get their balance sheet to below the levels they need it to be. So they've deleveraged so much that they have excess capital, and we'll have to see what they do with the excess capital. Do they start paying a nice dividend? Do they do M&A? I don't know. But I think both sides of that equation are interesting. PSTH, what a disaster that's been. It all comes down to whether or not you think he can get this Spark approved. I think there's a pretty good argument to be made that he can't. I don't really know how the SEC opens up that Pandora's box. I think it was actually Sheep that mentioned this to me, and I think he's right. I can't imagine there being 50 or 100 securities trading out there that have no capital involved in them that can kind of be manipulated and used to promote other vehicles. For instance, in this example, he's going to pitch the Spark so that the next time there's a deal, you get a new Spark, and it's kind of all very convoluted to me. I think he had good intentions with it, but I don't think it's going to happen. That said, even if the spark doesn't happen, he has 12 months or 14 months to find a deal. So obviously in 1970, I like PSTH a lot. If you have capital, you could even go on margin with it because it's marginable. I think I have a sizable position in that. I'm fine with holding it. My oil and gas names are BSM and AMPY. I also own CEQP preferreds. I own all those in pretty big size. Very bullish on BSM and AMPY. They're very similar in the fact that they hedged out almost all of their 2021 at really low prices. And they've even hedged out a lot of 2022 at low prices. So the market hasn't really given them any respect for the underlying assets they have, given that the forward curve on oil and gas, of course, is downward sloping. I think that the margin of safety on both is huge. You can read about BSM on Value Investors Club with the delayed membership. You can read the last write-up. You can also read about AMPY. Someone recently wrote up a long Substack on it that really goes into the story well. And again, that I just think there's an unbelievable asymmetry there with both of those. I do want to talk about a new name. This is very risky, and I haven't even mentioned this on Twitter yet. And I can't overestimate enough how risky it is. But there's a biotech stock, ticker CCXI, ChemoCentryx, and this story I find pretty fascinating. So this is going to go back to the BMYRT days. ChemoCentryx is basically like a one-trick pony, and they have a drug under review by the FDA, and there was an AdCom for it. I'm not even going to discuss anything about the drug. I don't know anything about it. Not relevant to the story. So the stock was in the mid 60s going into the AdCom in April, and the briefing docs, which is something you release before an AdCom, the FDA releases them to help guide the discussion for the AdCom, came out and was very negative, and the stock blew up. And then the AdCom came out and the vote was mixed. It was like 8-8, it was equal. And the stock blew up again, and the stock went to the low $10, $12 range. The general consensus was that this drug was not going to get approved. It was going to get what's called a CRL. In early July, right around the date of the PDUFA, the FDA issued a major amendment for CCXI. It extended their PDUFA by 3 months. Since then, CCXI has done two fireside chats, and they also reported earnings. And you can watch all of these videos on their website. Now, you're not going to learn a lot from these videos. The CEO is a little promotional, and he was the founder, and he is confident that he seems confident in approval, but not overconfident. And he also kind of makes it clear that they were very proactive with the FDA, submitting a huge amount of information after the AdCom to try to address the issues that the FDA raised at the AdCom. You don't really come away from those fireside chats all warm and fuzzy that the CEO is in the know that the FDA is going to approve this drug. So why do I like it? What's the rationale behind this? So there's two things that CCXI is going for, but the main one is the major amendment. And we should talk about major amendments because we're all very familiar with major amendments from the BMYRT days. So during COVID, the FDA has missed PDUFAs. They usually miss PDUFAs because of inspection-related issues, which is what happened with Lysocell, of course. With Lysocell, they also got a major amendment. They got that back in April or May, ahead of its July PDUFA. That's pretty rare. Usually the major amendments come much closer to the PDUFA date. Now, this is what's important. You have to go read the documentation behind why the FDA can or will give a drug or a NDA a major amendment. It's pretty clear what the statute says. So I'm just taking this from memory, but the statute basically says that there is reason to believe they can approve it in the first cycle. That's right there in the statute. You do not give a major amendment unless you think it can lead to a first cycle approval. I can't overstate that enough. So for instance, just to review data because the company wants you to review it, that is not a reason for a major amendment. The second very important thing is that you're not supposed to give a major amendment if you've already decided the decision internally. So if the FDA had decided that they were going to give this complete response letter, and they would have decided that weeks ahead of the PDUFA, they cannot declare and accept a major amendment. They're supposed to just give it a complete response letter. Because that makes sense, because right, the first reason is that you're only supposed to give a major amendment if it's going to lead to approval. And finally, the third reason is you're not supposed to push data on the FDA. Major amendments should only really happen if the FDA requests information, the company gives you so much, you then deem it a major amendment and you add the 90 days to the PDUFA date. Historically, something like 90% of all major amendments are approved. It's overwhelmingly high, okay? The market is very confused about the FDA these days. So another drug got a major amendment just a few months earlier, and it was ticker, I believe, ARDX was the ticker, and Ardelyx. And what's amazing about this name is that everybody thought this was going to get approved. This wasn't controversial. And instead of being approved, they got, I believe, a deficiency letter and then a CRL a few weeks later. So what is a deficiency letter? This is also important to the story. The FDA has begun issuing these letters a few weeks to a month before the PDUFA date if they are planning on giving you a CRL. The letter basically states there are one or more deficiencies in the application, and this precludes us being able to enter labeling discussions. Labeling discussions are the last thing a company does with the FDA when they are going through an NDA. The idea of labeling discussions is you try to figure out, as it sounds, obviously the label, but the label is really important for people that don't know about biotech. It could say, we recommend this drug for people in, only in this subset or in this age group, or you can make it really restrictive to, what drugs you have to try first before you try this drug, or you can make it to where you have to have massive monitoring in case there's major side effects. All these things affect the commercial viability of the drug, of course. In the case of CCXI, they never got a deficiency letter, and their PDUFA date is less than a month away now. It's like 3 weeks away or 3.5 weeks away, I think, month away, something like that. It's close. And there's no deficiency letter yet. You put all this together, you ask yourself, what's going on with CCXI, okay? You don't come away, like I said, from listening to those fireside chats that the company has extreme confidence, but you also wonder why on earth they even did these fireside chats ahead of this PDUFA date. Why not just keep their mouth shut, see what happens with the PDUFA, and then talk to the street? I don't have a good answer to that. What I do have is some suggestions about some trades you can make that will pay huge multiples if this gets approved. So there's two different paths this approval can go down. One is that they have a strict label, and that limits this commercial viability of the drug. And a lot of people think it only goes to the upper 20s if that happens. For that trade, I have on 2030 call spreads, October 2030 call spreads. And I believe you could put those on for I don't know, $2, $1.95, $1.80, something like that. And for that, it's almost certain that the stock will go to 25. So you'll guaranteed to make some money in any approval. It's a more conservative way to play it. You're gonna put up $2 and you'll make $8 for something that historically, like I said, should have like a 90% chance of approval. People are skeptical of that 90% number because the AdCom was mixed, the briefing docs were terrible, and the last drug that got a major amendment got a CRL. See, I look at it differently. The last drug got a major amendment, got a CRL. To me, that means that's the 1 in 10 that didn't get approved, right? You can't just keep CRLing every drug that gets a major amendment. It goes against statute, and it makes the agency look bad. So when I see lots of CRLs, I look at it as, again, terrible analogy, but the roulette wheel just got, 0 3 times in a row. I can't get 0 again. The reason why that's a terrible analogy is every spin of the roulette wheel is independent of the previous spins, and the 3 previous black wheels have nothing to do with each other. I don't think that's the case with the FDA. I don't think that every FDA decision is independent of each other. Of course, if you have an easy FDA that approves everything, and the historical decisions show that, then you're excited about future decisions. The way I'm positioning this is that if you've CRL'd a few things recently, especially with a major amendment, I don't think that necessarily speaks to the FDA is now a CRLing machine. I think it's it's a very small N, if you will, from my SRBT days. I don't think that means that you're likely to get CRLs going forward. I don't really see why the FDA would have deemed this a major amendment if they didn't want to just get it over with. So this is an orphan drug that it would be the first approved drug in this indication, I think, in 20 years. And something like 97% of physicians that have been surveyed said they will want to be able to use it if it gets approved. Now, it's not breakthrough designation. I don't believe the drug had priority when it filed its NDA. So, we're not talking about lysocell and ide-cel here, last in line, for cancer. But there's a reasonable case to be made that this drug does good, and that if they don't approve it, it will never go to market. I think it would take years, apparently, to run another trial, and the company won't put the money behind it if they don't get approved. One interesting pushback the company is giving the FDA is the FDA was mad at the trial design during the AdCom. And the company is adamant that the former FDA, those officials are not there anymore, agreed on the trial design. And part of the major amendment was showing the correspondence with the FDA that, hey, you guys told us this trial design was okay, and now you're telling us it's not. What precedence does that set? I think that you have a pretty good shot. They have a pretty good shot of this being approved. So the second trade I like is if you get a clean label, there's no reason why the stock can't be above $45 on approval. It was $65 before the AdCom. Biotech's been crushed since the spring. But if it was $65 before the AdCom, it might have went to $80 on approval, or $85 or $90 on approval. So I like November 35, 45 call spreads. I put those on a few weeks ago, and those can be had for under $1. I think you can put them on for like 75 or 80 cents, even less than that, maybe even 50 or 60 cents. I don't know. Let's see. I'll try to put some on right now. Can't get them on at 70 cents, but I'm guessing at 75 or 80 cents you can get them on. So that's CCXI, kind of interesting binary that's coming up. And the last thing I want to talk about very briefly, which I have no position on in my portfolio, but I did sell some puts on in my family account, is Apron, APRN, only because this was such a weird thing that happened yesterday. So Apron is that company that mails, I think, food kits. That has been a failure because nobody wants to do food kits anymore. And yesterday, in the middle of the day at 2:30 Eastern, when the stock was at a 52-week low, below 4, I think it was like a 350 or 375, they announced a large bought deal and a simultaneous rights offering with the previous founders of the company and insiders. And they are paying $10 a share for a unit in Apron Holdings. It was trading again at $3.80. They're paying $10. Now, what do they get for that $10? They get 1 share of stock, and they get 1.4 warrants that start at a 15 strike, go to 18 and 20 and maybe 22. I can't remember the exact number. I believe that those 1.4 warrants are worth no more than $2 today. I'm just coming up with that with a very crude, in a crude manner. And If they're worth no more than $2 today, and they paid $10 for the unit, that means a large amount of stock, $80+ million, traded at $8 a share, $10 minus $2 for the value of the warrants. $8 a share for a stock trading $3.80 is, beyond takeout premium prices. And you don't see it every day. In fact, this is what Immunovant should have done when they did their deal with Roivant. They should have done it as a rights offering, which is how this was done, way above the market. And if people don't want to participate, that's fine, but it shows you how bullish Roivant is on Immunovant. And that's what this signals. So for me, and I think I still like this trade a lot, is I sold October 5 puts for 60 cents because I think the stock will hold its own here and probably be bid in the coming weeks as people digest that they now are infused with capital, and that people that know the business better than you and I do were willing to pay $8 a share for it, while we can buy it right now at $5.20. I do not own the common. I have no interest in owning this business. It was more a way for me to profit off of short-term elevated vol in an idea that I thought did a transaction unlike anything I've ever seen before. I think that's it. What else you guys got for me? Oh, a lot of stuff here. Good. Too risky, CCXI. Can't trust FDA with how predictable they are. So my answer to that is when I originally put these on, I paid 60 cents for the November call spreads. I paid 60 cents to make $10. For the October call spreads, I paid $1.20 at the time to make $10. And what I told you was just a fact regarding what the major amendment language is. It's not that they're going to get approved. It's that if you look historically at what major amendments are and why they give them, and you just look at the numbers and the odds, that's where you're at. And it's definitely more than 50%. If you were going to tell me I had to risk my life on deciding whether CCXI would be approved or rejected, undeniably, I would tell you approved. It's just based on historical math, numbers. And if that's the case, then I want to take the bet on those call spreads. If I recall correctly, they completely hid the secondary steroid usage going into the briefing docs. And ADRs claimed they were in label discussions before the extension. I don't know about the labeling discussions, Uni. Regarding the hiding of the secondary steroid usage, again, no idea. If all these things are true, again, the beauty of me not being involved in biotech and for me not knowing anything about this drug, I didn't listen to the AdCom, I didn't read the briefing docs, is I won't get bogged down in trying to analyze the situation from a biotech or science position. I'm purely analyzing it from the major amendment. I had no position in this going into the PDUFA. All I've done now is look at the, I've listened twice each time to the fireside chats, and I have studied the major amendment documents and what makes a major amendment. That's it. And I can't come around to why the FDA would have been open, especially just days before the PDUFA, to deem a major amendment if there was fraud, right? If they hid something and the FDA said, no, you guys are fraud. Sorry. That's not what they do. They don't extend PDUFAs by 3 months for that, just because you want to. Can't bring myself to make a play where I have to rely on the FDA to create value. Would rather rely on management data. I don't know, again, I don't really do much biotech. So for me, I rather rely on statistics, and the statistics here are what major amendments are and how many what are approved based on major amendments. Back in December 2019, my XSI cover calls got assigned to 30. I was looking again and thinking October 15 cover calls aside, they're trading at $4.9. I mean, look, there's a lot of ways to skin a cat. I don't know if cover calls is the right move here. Cover calls, you're just selling a put. And there's definitely a downside here if they don't get approved. So I don't want to own this common. I don't want to sell puts on it. I want to define trade where I can make 10, 15 times my money. Now it would be 5 to 15 times your money. Hi, Matt. I saw you post this earlier. I thought you were sharing Norm YouTube videos. Happy to see you. Thank you, Bill. Uni, they have to seriously review any new data, right? And they have to run their all analysis on any data. It's not like you can just read the submitted package. Do you have the data 90% major movers? See, that's where you're wrong, Uni. They do not have to seriously review any data. The statute says that the companies cannot push data on the FDA. They're strongly discouraged to do it. And then the FDA is not required, nor should they grant the major amendment if they've already made up their mind about the CRL, and they're not supposed to do a major amendment unless it could lead to approval in the first cycle. It's all in the statute. So I don't know when they submitted that data. I can just tell you that the FDA did not do this just to appease the company. And I would think that if by now, in the middle of September, the FDA was not engaged with the company and kind of ghosting them, I think the company would not be talking the way they are on these fireside chats. It's not that I trust them. I just don't think they would be focusing so much on this lead drug if they felt very confident they were going to get a CRL in 3 weeks. It doesn't help them in any way. They're not raising any money right now. I don't see the upside for them. The 90% approval for major amendments, I don't have, that's not, I got that from last year when sell side was doing analysis on lysocell. It was in the high 80s, 85 to 90%, something like that. It might have been 92%, 91% if they had breakthrough designation. Or it was 90% if you had breakthrough designation, and it was 90% if you have major amendments. But I can assure you that those numbers are accurate. It was like high 80s to 90%. Hey, Glenn, how you doing, buddy? And the lack of a deficiency letter is a big deal, I think. How come the FDA hasn't issued a deficiency letter to them yet, saying we can't enter into marketing discussions with you? AXSM is a extremely interesting situation too. I have on the tiniest call spread in that, 1/10 the size of my CCXI call spread. So AXSM was another drug that everybody was pretty sure was going to get approved. Very clean data, not controversial. And then all of a sudden they get this deficiency letter, breakthrough designation, I believe, priority review. Then they get this deficiency letter that says there's a deficiency in their application and it precludes marketing discussions, labeling discussions. Stock went from 60 to 20. And then the PDUFA comes and there's no major amendment, no detailed analysis about why, but the FDA missed the PDUFA, which again does not happen outside of COVID and inspection issues. It simply doesn't happen. It happened with Sarepta back with the Teplocin. That was the last time I can remember this happening. It's happened less than 5 times probably in 25 years, where a PDUFA is missed. It's not because of COVID inspection related issues, and there's no major amendment. We're now a full month or longer, 6 weeks, I think, since the AXSM PDUFA date, and nothing. No CRL, no comments from management, except that most people think this drug should be approved. Again, I have like the smallest little gambling position. It's a DEC 40-50 call spread. I lose more money on every tick with Groupon than I do with this. So I wasn't going to mention it. But that one is fascinating. And truthfully, I think CCXI probably has a better chance of approval than AXSM does. There's no deficiency letter with CCXI, and it got a major amendment. AXSM has no major amendment, so there's no reason why the extension has to lead to approval. It's not in the statute. And we we have no idea what's going on there. Anything else? Oh, I'm glad we agree with that, Uni. But AXSM is pricing in, not a 50% chance, of course, but it's pricing in a decent chance now. I know they have other drugs too. It's a much more complicated company. They have a deeper pipeline. People are worried if number 5 doesn't get approved, then why would number 7 get approved? They're worried about, I guess, because maybe there's a problem with the underlying company. Thank you, Greenblatt. I don't know when I'm going to be back again. I'm taking it day by day, but I wanted to speak to you guys. I definitely wanted to speak about Groupon. I think if you read deficiency letter regulations, it satisfies meeting the PDUFA date. Well, that's interesting, Uni, if that's true. That's very interesting. About AXSEM. But still, why not just issue the CRL? Right? I mean, plenty of companies that have gotten deficiency letters still get the CRL by the PDUFA date. And now we're weeks and weeks and weeks after it. It's not that hard to write a complete response letter. Definitely not 6 weeks or 5 weeks after the PDUFA date. Especially if they did the deficiency letter, I think the deficiency letter was given out the last week of July. And the FDA ghosted them. The FDA did not communicate what the deficiencies were, right? We're told at the PDUFA date, AXSM was given a webcam. Well, they were given like a Zoom meeting, and they were notified they were going to miss the PDUFA date, but they didn't tell us anything else about it. All right. I'm going to log off. I will speak to you guys again if anything interesting happens to any of my names. Look, the last thing I'll say is this. I'm still up for the year, much less, of course. And that's all from my oil and gas names and Dell. The first half of the year, I made a ton of money on Dell, and I made a ton of money on BSM, AMPY, and CEQP PR. And I made money on MagnaChip. MagnaChip's higher than it was at the beginning of the year. It's comforting to me that today, I'm looking at Groupon at $21, MagnaChip at $18, and I have a reloaded position in Groupon with all these call spreads, and it's just a very different proposition than when it was trading at $35, $45, $55. So, I can see big upside in my P&L, big upside in my account. I don't know when it's going to happen, how that works out, but I feel the stock. I mean, God, just do a search for the ticker on Twitter. It's dead. This is a dead company. There's nothing except over 4 million shares that have been shorted that all have to buy back. That's the beauty of short interest. It's already been sold. It needs to be repurchased now. So we'll see what happens, but I am increasingly optimistic. And I think the stock is way oversold. It should never have went this low based on the color that they gave. It's mostly a messaging problem. And I'm hopeful that they work out the messaging. I'm definitely being very proactive with trying to help them with the messaging. And we'll see what happens. We'll see what happens. Thanks, Uni. Appreciate it, man. All right, guys. Thanks to 10 of you. Take care. Peace. Have a great weekend.